What's up, outliers? Today we're going to talk about how to use unusual options activity. We're going to talk about what it is, what the profit mechanisms are, how to identify it, and then we're going to talk about specific ways to implement strategies wrapped around this concept. And then I'm going to give you an example. The example we're going to talk about is a trade that made a little over 95 grand in like 3 days. Now, that's really designed to catch attention. There's plenty of versions where these lose, but the broad idea behind unusual options activity, as far as I typically trade it, is they do provide pretty significant risk reward opportunities asymmetrically, meaning we're looking for bigger wins and pretty frequent but smaller losses. So first off, what is unusual options activity? It's really simple. It's when we see abnormal option trading patterns and things like really high volume just as a relative metric, large blocks, sweeps, which are different kinds of trades that are placed on the institutional side typically, really big changes in open interest, IV going off the charts, looking at open interest relative to volume, which we'll take a look at all of these. The main thing to pay attention to in the example that we're going to look at is if we just eyeball this stock SBET, we can see over the last 30 days, we can see what the average volume options premium was over different days. And we can see that there's some spikes and then some drops. And then all of a sudden we can see that there's some really profound moves that then quickly reverse. This is an example of unusual options activity that we're going to double click into. The trick here is that there's a lot of false flags. And I generally would say for most people, unusual options activity is something to take a look at later in your trading career once you have kind of core strategies built out, because there is a lot of discretion that goes into identifying unusual options activity and context that's needed. Because there's a lot of things that might look like unusual options activity that really isn't that unusual, again, once you develop the context window. So what are the profit mechanisms here? For those that don't know, I use what I like to refer to as the outlier strategy process, and I'll throw a link to that below. But this is the base for anything that we're going to try to build to trade. So the overall effect, the market effect here is unusual options activity, but we need to identify how we can actually monetize it. And there's two primary ways: through trading the direction, so price direction via continuations, and then volatility, which we'll talk about both of those. The main people that are causing unusual options activity are generally institutions, and they're normally different kinds of, for what we're specifically interested in, different kinds of informed speculators that are looking for leverage, or literally insider trading, which we can identify. As always, I have spent literally an insane amount of time studying this market effect and building different strategies around it, but you should never take my word for it. You should be able to look things up on your own. So in this case, this is a paper from McGill University, and they're talking about, do we see a series of strange trading behavior leading into M&A announcements? And shocker, we do. Same thing when we see prior to takeovers, we do see options activity that clearly is preemptive moves. This extends further. This extends to informed traders that might have an idea of what's coming up for an earnings release or a product release. The reason why traders use options for these is because they want leverage. If you had some sort of insider information or a really good idea of what's going to happen in something, people tend to not use stock when possible because stock doesn't give you the same leverage that options do. Now, this seeking of leverage naturally gives us some ideas on what this can look like. So as I already mentioned before, big volume over OI. What is this? Well, if we go into an options chain for SBET, just because it's up and this is the example I'm going to use. And fun fact, this isn't the move that I traded and made that money on. It's this move, much smaller, much less interesting, but still the effect is powerful, and I'll show you. But if we go into the options chain, we can see that there's open interest, which is just the total number of open contracts updated at the end of the day, and then volume. So what I can do is we can go into individual options chain and we can come up with an idea of what might be going on. So for example, if I take a look at this options chain, it's not a good example for unusual options activity, but it's a good example of volume over OI. The current open interest for this contract is 146 options exist here. And if we take a look at the volume today, the volume was 347 contracts. So what that tells us is definitively some of these are opening trades, no matter what. They can't be all closing trades because they don't exist. There's 146 OI. So the total volume over OI in this case is 2.4, which that ratio won't make a lot of sense until you develop an understanding of what the ratios tend to be. A good example over here is this option chain is 246 times volume over OI. One of the things you'll notice is a lot of times it will be based on what the current OI is. So it's easier for contracts that have really low OI to have really high multiples. This is why it's a little bit of context dependent on how you choose to scan for these. Next is just big overall volume. Sometimes we can see that the volume in an options chain just starts to go haywire compared to what it typically looks like. Again, sticking with SBET for the example, we can see that total volume is kind of mellow in mid-June, late June. And then all of a sudden, early July, it starts going a bit haywire. And then it really starts to get expanded out. This is an example of just the general options chain taking on a lot of volume that might call for attention. Large relative premiums. So if we take a look at this very same options chain, and instead we take a look at net premiums, like I was showing you at the beginning of the example. These are overall net call and put premiums broken out, but we can see that something weird is going on here. Now, again, sometimes there's a perfectly good explanation, but a lot of times there isn't. And the job is to try to decipher these through some of these other tools. So let's take a look at how we actually identify these circumstances. A lot of times I'll start with different kinds of scans to look for unusual relative volume or OI changes or volume over OI. The way to do this is, again, depending on your platform, you can set up a really basic scan. So in this case, this one's looking for volume over OI that is worth at least $50,000 in premium to avoid really small trades that are out of the money. Why out of the money? Because a lot of times in the money trades are used for different kind of stock replication or hedging activity that doesn't necessarily associate with directional speculation. So in this case, if I'm looking for directional speculation, I want stuff that's generally out of the money and stuff that's actually relatively closer in time. Because the only reason why you buy out of the money calls that expire in 30 days is if you think something directionally is going to happen. That's not like a really sound hedging position for most instances. Again, not all, but for most. So by identifying some of those traits, we can create really pointed scans that help us find these things. Next, if I were to think about these in terms of the most useful inputs, I think this is really important to note. So looking at concentration in specific strikes or specific terms or expirations. So what that means is, if I'm looking across a stock, it's very difficult to see necessarily what's going on here if I look at it from this lens. But what I can do is say, okay, of the 315,000 calls against 197,000 open puts, that already is call skew in terms of OI. This is not usually the case. More often than not, especially for bigger stocks, you'll see more put buying activity, and that's because most people hold the stock and then they'll hedge with puts. But this is a general directional bias that we see here. Now, if I want to see where this is broken out, I can just flip through the expirations and I can see where the concentrations are. Most of the time, you'll see concentrations in the primary expirations. That's where liquidity is typically highest. And then in the front expirations, if there is some sort of expectation of near-term move. Now, how can we use this stuff? Well, I typically will try to trade it in one of three ways: either continuation of whatever the expected move is. So if I'm seeing a bunch of big out of the money call buying, my expectation is that price might move in that direction, or reversals after that occurs, or also trading the volatility, because a lot of times if we're seeing really big aggressive transactions, vol will go up, and you can literally trade the relative volatility of individual options compared to others based on that option being bid up pretty massively. So once we identify which of these profit mechanisms we're looking to target in the example, it's really important to pay attention to the term being used, because that informs what kind of trade subsequently goes on. So what that means is if I'm seeing really a ton of really big trades, but they're going on a year from now, that's a completely different inference, and honestly less impactful than if I see a bunch of big trades going on for, 2 weeks from now. And the reason being is, again, that expectation of movement. Those big options that might be put on really far out in time could just be generally bullish bets on the idea that this thing is going to go up, versus something that's going on much nearer term. So the term of the unusual options activity matters a whole lot. With that in mind, we then build trades that align what our expectation is based on the analysis that we've done. And then we find something that can help capitalize on that movement, which I want to give you an example of now. So if we continue looking at SBET, what ended up happening was on 14 July, there was really, really strong near-term options activity, and it was clear that they were being bought up. So this started on the 11th, and then if we take a look at the 14th, it really hits a pinnacle. So if I show you the total call premium, the net call premiums on this point during the day, it's 6.67 million. For context, before all this was going on, it's like 50,000 to 100,000. The day before, the peak was 3.81 million. So it literally doubled. That, to me, these 2 days in a row draws my attention. So I see that going on. And because of that, I buy some options. What do I buy? I go into the 15 AUG expiration. So again, this is 14 July. I'm going out to August. These are pretty near term in time for me. But I don't like going so close in time because, again, you never really know if this is actually unusual options activity with a directional bet or if there's something else going on. So if you ride that bet too hard, then you can trade really near-term options and then just get lit up, meaning you can lose a bunch of money really fast. So this allows me to strike a balance between gaining exposure to the effect, but giving it some time so that if it's wrong, I'm not essentially washing away all the capital. So in this case, there was 2 trades. I did 75 of the 30 calls, and then I did 50 of the 41s. The way to look at these is this is like the base trade. The 75 of the 30s this is the main trade that I'm centering on. And then the 41s are there as kicker options. If this thing really starts to move, I'm putting out way less money relative, but these can compound quite massively. So the total debit, this isn't a credit in this case, the total debit was 36,575. So total cost, 36K, which is well less than 1% of the portfolio. Don't let the dollar signs mean anything to you. This is all scaled to a portfolio. These are really high speculative trades for me. So I size these small relative to the portfolio. So then on 15 July, the options activity persisted. It did start to slow down a little bit. So I chose to take partial profit. So if we take a look at the 15th, we can see that this options activity continued. And most importantly is I didn't see these getting unwound. How can I see if these are getting unwound? I can look at the individual options chain. So using this random option as an example, I can see what the general price is that it's being filled at, and then I can look at the individual volume for this individual option. So then I can see what that volume constitutes, whether it's bought or sold. Now, again, you always have to remember this is not definitive. These are assumptions, meaning whether it transacted at the bid or ask, and then we attach whether or not the trade was most likely bought or sold, but it's not perfect. So you kind of have to keep that in the back of your mind as you're looking at this stuff. So I can see that that didn't happen here. So I didn't want to take the full trade down. I wanted to let more of it go. So all I did here was SBET was up about 20%, around high 28s. And I took down the 41 calls. So those went, I bought them for 229. I took them down for 860. So on that trade by itself, I essentially realized $31,500. This is the compounding effect. So the total dollar amount isn't anything crazy relative to the price. It's still a really good return, but the real power in these is the compounding effect. So that's why those came down first, also because they're further out of the money. So they're more sensitive at this point to time. Price came in a little bit. These aren't that far out in time if time continues to run too fast, or if volatility comes down in that term. Those both hurt this position. So then on 16 July, I take a little bit more down. So this was up around another 20% at 36. I took down 40 of the 75 of these, and I took them down for 1239. That realizes a P&L of 36,160. So again, you notice how the total P&L here is really solid relative, because I'm only taking down 40 when there's 75. But as a percent basis, it's still less than what I made on the further out of the monies that had that pretty good move. Then on 17 July, I flatten out the whole thing. SBET really started to lose the overall momentum. So this was at when is that like 37 and change. I took down the rest of these for 1185. That gave me 29,750. So realistically, between these two positions relative to the original outlay for the corresponding trade, I made, again, a little over 2 times the investment here, whereas this still was essentially 3 times the investment. So this turned out to be, again, a little over 95, which is a 266% return on invested capital. That's the asymmetric component to these in a relatively short time frame. Now, what SBET ended up looking like here is you can see that on the 16th, there's this big unwind in the options. So this is a lot of people closing out what has been built and made over time. But I saw this spread out across different expirations. And very frequently, I'll see it trickle a little bit more. So that's why I didn't flatten the entire thing. I just took most of it down. And then the rest of it came down on the 17th as it was confirmed by price starting to roll down. You can also take a look at what things like RSI were doing on this day. So again, it's in this window here. And then we can see that the RSI really started to flatten out and then roll down. So that is my indication to take exit stage left. So this is just one example of using options to help inform trade ideas based on what might be informed speculative traders. This is not bulletproof. There's lots of times where this will lose, but the cool part is, generally speaking, the losses are much less than what could be made on a well-developed strategy. This is one of the primary profit mechanisms that we work on in like the pro community, because this does take a lot of shaping to get your hands around, because there's so many instances where you can see big options, volume, or open interest changes that are completely rational. So an example of that in this case is, let's say that you see a ton of options being bought or sold, but then you realize it's an expiration day. So that can be stuff that's just being rolled out in time, right? There's not a whole lot to take from that necessarily. As always, if you have any questions, let me know. Be an outlier. See you later.